Hi everybody, welcome to our fall market update with Louisbourg Investments. I have Mathieu Roy, VP of Equities with me to talk a little bit about the equity markets and our funds and how we've been positioned coming into the fall. So Matt, tell us a little bit about what you guys have been doing and what's been happening leading up to the fall investment period.
Sure. Well, I think everybody's aware that it's been an exceptional time to invest in equities. There's a global pandemic, but investors are enjoying some very attractive returns.
Sure.
In Q3, it looked a little bit like investors took the summer off to reflect on the first half gains. Despite that, markets are still very strong. Looking at Canada in particular, you can look at a variety of markets. We're up 17.5%. So very strong returns. And part of the reason that investors are pausing or pressing the pause button is wondering when central banks are going to start raising interest rates to fight inflation.
Sure.
So investors are paying attention to employment data, to inflation data, and tips that they may be getting from central bankers.
Right.
That's the biggest macro question by investors.
Mm-hmm.
If you think how we're positioning the portfolio and how it's behaved, our large cap Canadian investments have performed well on a year-to-date basis. Q3 was not an exception. We had a good quarter.
Mm-hmm.
And really what we like about it, it was driven by some of our high-quality businesses that we like to preach about.
Yeah.
Thomson Reuters, Colliers, Loblaws, all very strong performers, all very profitable businesses, highly recurring in nature, generated a lot of free cash flow. So very happy to see that. Another company that sneaks into our top contributors list is Whitecap, which is a mid-cap energy company. Always been high quality, but just post-COVID, it was a challenging time for that sector.
Sure.
They spent a lot of that time acquiring attractive businesses, took advantage of their balance sheet. So now the company's in better shape, is inexpensive, generating a lot of free cash flow and returning a lot of that cash to shareholders. That's a new investment. It came back to the fund as it grew in size and was too large for a small cap strategy.
Okay.
One of the investments that was not working so well this quarter, but has worked well historically for us is Saputo Group,
Sure.
So food manufacturing.
Mm-hmm.
It's a challenging time in terms of the labor force. That's part of the inflation pressures that we're seeing.
Right.
And the dairy market is one that is lumpy in nature, but they're terrific operators. And we took advantage of that stock price weakness and we've increased our position significantly. So we may get another extra quarter, but we're getting the stock and the shares of the company at one of its weakest points in terms of price to forecasted profitability. And it's a big free cash flow generator, and you're invested alongside the family that owns a significant stake.
Exactly.
So very attractive business. Yeah. Dental Corp is a new company, a new IPO. They consolidate the dental market in Canada. Mm-hmm. Another very attractive business, a new business that we're able to invest in. Generates a lot of free cash flow, puts that towards acquisitions. So that's one of the kind of the highlights of the quarter in terms of our large cap investments.
Sure.
One thing that we would like to communicate to investors is we feel that this is a very balanced time to be, that you should take a balanced approach in terms of investing in equities. If you look at the last 10 years, it's really been high-flying tech companies that have led the way. Mm-hmm. Part of that is warranted, but there's been a lot of multiple appreciation in terms of where they trade. So you should be cautious in certain pockets of the market.
Right.
The way that we're structuring the portfolio today is we want to get paid for risk. So we want to invest in businesses that have above average growth and some risk alongside, but pay a fair valuation for that. And we're seeing some of those opportunities in the resource sector, in the industrial sector, and real estate.
Okay.
In other sectors where we don't feel we're getting fairly compensated at the current time, we're underweight, so we have less investments there.
Sure.
So in financials and technology, in Canada anyways, we're lighter than the market.
Right.
And we'd rather take those dollars and invest it in some of those stable businesses we were talking about, like Saputo and Loblaws, for example.
Right.
I think that sums up a little bit what's been going on in the market and what we've been doing and how we should position the portfolios on a go-forward basis.
All right. Thank you very much, Matt, for those insights. Looking forward to catching up next time.